Hello and welcome. My name is Rahim. I'm a property investor. In today's video, I'm going to share the 5 common mistakes people make in investment mortgages and how to avoid these 5 mistakes. Before we get going, if you like this video or any of my video, don't forget to hit the like button below and subscribe to my YouTube channel for more of this video, especially if you want to immerse yourself in property investing. So let's get going. So how to avoid 5 common mistakes in investment mortgages. Number one mistakes, lots of people invest with their heart instead of their mind. So when they start looking at property that they're looking to buy or invest in, they start thinking about their home, how they want the home to be. So they end up making so many sort of mistakes like buying expensive paint, buying the most expensive kitchen, buying the most expensive furniture. So you need to know what sort of properties you're buying. You need to know what your target market is, and then you can bring that into the actual renovation. And also, people tend to think about paying down the mortgage when they got the investment property. They're not thinking about maybe having enough cash flow. You're thinking about paying it down. Depends what sort of strategy you do, but as an investment property, you don't really want to be paying down your mortgage. The reason is because you would have less profit, less cash flow. So don't start thinking about, okay, I want to pay off my buy-to-let mortgage as quickly as possible so that I'll be able to get the property. I'll own the property outright, so I don't need to worry about paying any interest. If that's your strategy, I would warn you to start thinking in an investment way of thinking, where you think about having it on interest only, and then that then generates you a lot more cash flow that you could actually use to buy another property. And also, what some investors also do, they tend to think about. Number two, when they want to invest in buy-to-let, they tend to approach their local bank, i.e. their local bank that provides them with the mortgage. Obviously, most of these banks, they're not really specialized in advising in investment properties. So they go there, they got the wrong advice, wrong information, they get deterred on investing, and then they end up not investing any of their money in buying properties because they may have got to the wrong bank, wrong location, and also had the wrong advice as well. So what I would advise if you want to buy a property is basically don't go to your local bank, find a mortgage broker who would go out there, who knows the market, who's got exposure to lots of market, that would go and find you the best deal or the best mortgage that is suitable for that specific property. So hence the reason why it's vitally important to ensure that you've got a mortgage broker who's got lots of exposure in the market. Number three, because they don't know what they're doing, they end up getting the wrong mortgage. Let me explain what I mean by wrong mortgage. Number one, they may take a mortgage that really is a short-term mortgage, right? Instead of going for 20-25 years mortgage, they tend to go for 10 years mortgage or 5 years mortgage term. So I'm not talking about the fixed time, right? I'm talking about the length of the mortgage. So they tend to go with that, and then obviously they end up having issues when it comes to remortgage, or if they couldn't remortgage their property for whatever reason. So I knew someone who recently come to my office who was impacted by that in 2008, because what happened was he took short-term mortgages hoping to buy them within 10 years or pay them off within 10 years. Obviously, he wasn't able to do that, and his mortgage was about to expire, and the mortgage was about to expire in 2008 and 9, which was the worst time you could ever want to mortgage your property, because by then the property market has gone down, and then he end up having negative equity because the actual mortgage end up being more than the actual value of the property. So that's one of the things you need to be very, very careful for. And the second mistake people make, they just take a mortgage. They don't really find out what sort of mortgage is it. We have different sort of mortgages, right? We have mortgages that only allow employed tenant, working professionals, right? We have some mortgages that don't allow you to have unemployed people in their properties, right? Or some mortgages don't allow you to do short-term let, or some mortgages don't even allow you to have the property as a service accommodation. So basically end up getting those mortgages, and they'll start doing short-term let or have an employed tenant in that property, and then obviously if anything goes wrong, they will struggle to actually be able to claim anything back or to seek compensation as a result, because they have gone against their mortgage. So it's vitally important for you to understand what sort of mortgage you are taking, and what sort of clients that mortgage would be suitable for. Are you looking for working professionals? Are you don't mind to have unemployed living in your property? So all these sort of mortgages, they've got different sort of hidden clause that you need to aware of. So again, vital important to get a mortgage advisor who would advise you what sort of mortgages they are. Also, if you're taking a mortgage, you need to have the end in mind. Are you looking to remortgage in a couple of years? Are you looking to mortgage in 3 years' time? Are you looking to mortgage in 5 years' time? Whatever your situation is, suppose you want to remortgage within, say, 2 years, you want to look for a mortgage that have lower redemption charges. Right, you don't want to go for a mortgage that got higher redemption charge. And again, having a good mortgage broker would advise on that basis. Unless you tell them what your exit strategy is, they will struggle to get that sort of mortgage. So it's vitally important for you to tell your mortgage broker what your actual strategies. Like I got one of my students who bought a property. He did it really well because he asked me, he nearly got the wrong mortgage. So he wanted to remortgage within a year. We were able to get a mortgage, a normal mortgage, which is a shocker sometimes, that would allow him to actually remortgage within a year or within 24 months without having high redemption charges. So we were able to go into that sort of mortgage, which then allows him to actually remortgage that property without having heavy redemption payment to pay, because sometimes that redemption could be anywhere from 2,000 to about 5,000 pounds, depending how long you've been on the mortgage. And also you need to know the terms of the mortgage, as I've discussed prior. You need to know how long you want the mortgage for. The longer the mortgage, the better for you. Suppose you were not able to remortgage your property after the fixed term. Say you had a 2 years fixed term or 3 years, whatever fixed term you had, and then that comes to end for whatever reason. Maybe you've lost your job, or you end up having a CCJ on your name, or you just not been able to actually remortgage. If you've got a shorter length of your mortgage, say 5 years or 10 years, you will struggle to remortgage, especially if you have difficulties getting a job, or you have some credit history problems. So it's vitally important for you to ensure that you are all covered when you are taking your mortgage. And also, some people like to be on a variable rate, some people like to be on a fixed rate. So variable rate, basically it changes every sort of month or every year, so it's not fixed. It goes up and down, it fluctuates. But for me personally, I like fixed interest rate mortgage. The reason is I know exactly how much the mortgage or how much the bank will deduct for lending me the 75%. So I like that. And also it gives me certainty. I know then I'm protected for the next two years if I did 2 years. And if I did 5 years, I know whether interest rate goes up and down, I'm still on that fixed rate. And the good news is right now, mortgage interest or interest rate is significant on the baseline. So if you can get a mortgage right now and lock yourself in it for 2 to 3 or 5 years, you're protected, because we now know if interest rate goes up, you are within that lower interest bracket. So I would advise, for me personally, it's not a financial advice. Everybody's different, and I'm not here to advise you financially, but I'm just here to share my experience and how I dealt with my properties. So what I do in my properties, I get them in a fixed interest rate to ensure that I know exactly how much mortgage payment I'm paying or how much interest I'm paying on my mortgage. So I know exactly what it is, and I'll be able to deduct it easily and know exactly what my net cash flow is. And again, that would help you understand every month what your net cash flow is. So vitally important for you to know what sort of interest or what sort of terms you want to go for. Do you want a fixed rate? Do you want a variable rate? Some people like variable rate because they want to be able to have that fluctuation. But for me, I like it to be safe, secure, and I know exactly what my cash flow is. Number 4, they get the wrong insurance, right? This some people call it basic, but it's vitally important to get the right insurance. If you haven't got the right insurance, you would literally basically shoot yourself on the you'll be shooting yourself on the legs. Insurance also similar with the mortgage slightly in terms of what sort of tenant type that they require. You need to know whether your insurance allows you to have unemployed in the property, whether they can only allow working professionals or families. So you need to know what sort of insurance it is, if they allow these sort of people, or what sort of market you are looking for, and then do your insurance in that basis. So having the right insurance is very important. I'll give an example of one of my properties in South Wales. I renovated the property, right? Shortly after I renovated this property, we had a massive snowfall in the mountain, so that then end up frozen up the pipes within the property itself. And then when the boiler kicked in, all the pipes were frozen, so the water flow did not go through, and then that then end up exploding into the kitchen, and then it caused a mess, and we had a massive flood. So then, if my insurance did not have flooding or leak or anything in it, I wouldn't be able to claim it, because when I started to claim, they did ask all these questions. They go through a tick box exercise. So if I hadn't got that, I would have lost my property value, as well as I would have foot the bill myself. I would have fixed the property myself. So vitally important for you to understand you against flood. Does it protect you against burst pipe? Does it protect you against leak? So all this sort of thing you need to understand before you take. So it's very important for you to know what sort of insurance you would take, right? Because going online to look for insurance may save you lots of money, but if you're not getting the right insurance, it will cost you a lot more. If it's worth paying an insurance broker to get you the best insurance, so pay for that upfront so you don't lose whenever you want to make a claim against your insurance. So know what sort of insurance you're taking for your tenant, know what sort of tenant will you be renting in that property, and know what's protected and what's not protected for your building insurance. And mainly here, I'm only talking about building insurance. I'm not talking about content here. I'm talking about building insurance, because in some occasions your tenants are responsible to take content insurance, not yourself, because you may not own the furniture or the equipment in the property. So, and again, vitally important for you to know that if they ever want to sell you content insurance, if you don't own the stuff within the property, there's no need for you to take content insurance. Number 5, they don't use the equity in the existing buy-to-let investment properties. Okay, they tend to say, oh, I'm gonna wait. Or some of them don't even know they can actually withdraw money from their existing buy-to-let properties. And again, I've been approached really recently by one of my students who came around. He was cash poor. He thought he didn't have money, but he had about 4 buy-to-let properties. So what we did was we literally look at the portfolio, and then we were able to pull some money from those properties, because some of those property had lots of equity in them. Some of them he's got them for 5 years, some he's got them for 10 years. He's never ever remortgaged those properties, so he had all those equity in there. So what we did was is to look at the timeline on when he's due to remortgage, and then what we did, some of them were in variable rates, so we were able to remortgage quickly, and then some of them were in fixed, so we were able to raise about 50 to 55,000 pounds only from remortgaging these four of his properties. So you go out there, look at your properties, look at your investment property. Even if you had them for 2 years, even if you had them for 3 or 5 years, look at the property prices has gone up. Property price in average goes up by 7.5% every year. So they would have gone up. Even if it's 10,000, 5,000, 15,000, you can use that plus the rent you would have received to invest and buy another property. So vitally important for you to review your portfolio to see if you're able to pull any cash out, to be able to reinvest it, buying a lot more properties that will get you to whether financially independent or financial freedom, whatever you are seeking for. To summarize, the 5 common mistakes in investment mortgages or properties are: number 1, people invest with their heart instead of their mind. So if you're one of those people, try to pull yourself away from it. I know you get distracted sometimes, but you have to pull your way away from it. Think with your mind, not with your heart. Okay. Number 2, they approach their local bank for their own that they had it with their residential property. Again, it's the wrong person to approach. You go out there, look at the market, so you're exposed to a wider market by having the right mortgage broker. Number 3, they get the wrong mortgage in the first place. So by having the wrong mortgage, that doesn't allow you to actually have unemployed tenant in the property, or mortgages that are very, very short. They don't go to 20 or 25 years, or mortgages that for whatever reason don't allow them to do any short-term let. Number 4, insurance. They get the wrong insurance that doesn't cover them for, say, flood risk or a burst pipe or a leak, stuff like that. So you need to ensure that whatever property you're buying or whatever insurance you're taking, building insurance to be specific, you need to ensure it covers some of these important things. And also you need to know whether the insurance allows you to rent to unemployed. And number 5, They don't use their equity. So if you are one of those people, stop that now, okay? Go and review your property portfolio. Look at it in a different angle. If you don't know what you're doing, get a mortgage broker or financial advisor. They would actually look at your portfolio and they would advise you how much money you'll be able to pull out to be able to reinvest. Obviously, your mortgage interest might go up slightly, but again, it's worth taking that money out and reinvest it for a higher cash flow. I would like to welcome you in my monthly free investment property crash course. So I do this crash course every month for people who are starting in property investment, or people who've already started who likes to get momentum or also have an update on the property market. And we also offer a free strategy call as well. If you want to call me, I'm happy to sit with you for 30 minutes to talk to you about property investment and understand what sort of things that you may be interested in. And also now I am offering something that I've never done in my life. I'm inviting people to come to my office to spend a day with me in form of a discovery day. Again, with the discovery day, we'll go through your business plan, recent property investment strategy, how you could invest in property passively without getting involved, and how you could raise money. And I'll be with you whole day answering any questions you may have, and obviously I will take you out for dinner or lunch as well. And also I've got my letting and estate agency. If you've got a property that you want to rent or you want us to manage, we've got bar properties. They are very, very good in the management side of things as well as sales. We tend to have below market property deals, and if you're interested in those sort of things, so do not hesitate to contact bar properties, which will help you buy below market by value or help you invest in a specific area that you may be interested in. Again, thank you so much for watching this video. If you like this video or any of my videos, so hit the like button below and subscribe to my YouTube channel for more of these videos. I really look forward to sharing the next video.